at the macro level, I think that we're playing a very dangerous game of chicken with the Fed.
Chamath believes that most of the layoffs and shutdowns we've seen since the beginning of 2022 have only just begun, and he advises investors that now is the time to start purchasing. Chamath did call most of these market indicators late last year, which he received a lot of heat for, but were definitely right on target. In his most recent All In podcast, he discusses why now is the time to buy and to keep an eye out for changes in the market in the coming months. The belief that higher interest rates serve to combat inflation is based on supply and demand economics. But how does it function in practice? Will it work when inflated prices appear to be beyond the grasp of traditional monetary policy, at least in part? Normally, the Federal Reserve is viewed as the cavalry, arriving to bring down skyrocketing prices. This time, though, the central bank will want assistance. Nonetheless, officials will attempt to slow the economy and restrict inflation. The central bank will take a two-step approach. It will hike short-term interest rates while simultaneously lowering the more than $8 trillion in bonds it has amassed over the years. In order to keep money flowing through the economy, the transfer of such steps into reduced inflation, according to the Fed design, means higher rates increase the cost of money and make borrowing less enticing. As a result, demand slows to catch up with supply, which has been severely behind throughout the last 2 years. Because there is less demand, retailers will be under pressure to lower prices in order to entice customers to buy their goods. Make sure to stay till the end of the video as Chamath will go over the economic and financial outlook for 2022. This is Library of Wealth. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
3 or 4 months ago, we only thought that there was going to be a handful of interest rate increases. And increasingly what has happened, the market has remained so resilient that the Fed has sort of put out more and more data as the data has justified them being a lot more aggressive. And it kind of crescendoed this past week where they basically said, listen, we're going to move by 50 basis point increments for the foreseeable 2 or 3 rate hikes, and we're going to start quantitative tightening. What does that mean? That means that instead of basically printing money and coming in and buying securities from the market, right? So what happens? When they enter the market with money that they literally do print and buy your bonds, they're giving you cash in return.
Chamath goes on to say that when quantitative tightening occurs, they're taking money out of the system, or in this case, they're going to let a bunch of maturities roll off and not renew the bonds because there's simply nothing else to buy. He says the reason this is important is because we have massive price issues, we have supply and demand issues, and the market keeps shaking it off, so the Fed will get even more aggressive. And you'll probably see quantitative tightening until there's a reprieve in the equity market.
And typically what that has led to is the inflation of all assets, right? Equity assets have gone up, bond assets have gone up because there's just nothing else to buy. When quantitative tightening happens, they reverse that. And what they're going to do is about $95 billion a month of the opposite action, which means they're taking money out of the system, right? Or in this case, what they're going to do is they're going to let a bunch of maturities roll off and not renew them. Okay, so why is this important? Well, it's important because we're still 4% from the highs. So we have 7% inflation. We have all this crazy stuff happening. We have a war, going on. We have massive price issues. We have supply demand issues, and the market keeps shaking it off.
Chamath says the Fed will keep ratcheting up pressure until they see that there is tremendous liquidity and continue trading all the way down to the enterprises in Silicon Valley. According to Chamath, you should start planning for the worst, which means that if you can't raise money on your terms for 18 months, you'll have to raise money on market terms. And if you're not in a position to show good growth over the next 2 years, just get your balance sheet in order and wait it out.
Like when you and I think this market is down 4%, we don't feel that because some of our companies are down 50 and 60%, right? But that's because we're all focused on high-tech growth. But they look at the broad indices, and the broad indices have held up really well. And mostly it's because, if you look inside the S&P 500, 40% of every dollar is, Apple, Amazon, Microsoft, etc., Tesla. So we're in a situation where I think until the Fed see that there's a massive trading of liquidity, which means like you see these indices crack big time, 3,600 in the S&P, they're just going to keep ratcheting things up. As it comes all the way down to our companies in Silicon Valley and tech, what that means is like you have to start planning for the worst. And I think the worst means that there's an 18-month period where you cannot raise money on your terms. You have to raise money on the market terms. And so if you're not in a position to show good growth over these next 2 years, I would encourage you to just get your balance sheet in order to wait it out.
What do you think about Chamath's outlook for 2022? Comment down below. You can catch the full video. Link is in the description. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.